Operating expense ratio, OER. So what is an operating expense ratio? The operating expense ratio, OER, is considered an important metric because it provides insight into how efficiently a company or property is managing its operating costs relative to its revenue, allowing investors and managers to assess financial health and identify areas for cost control and potential profit improvement. Lower OER generally indicates better cost management and higher potential profitability. When approaching a lender for financing, this ratio is one way to show your operation's financial stability and can influence how much it will cost you to borrow money to sustain your operations, It's important for producers to pay attention to it because you can't maximize efficiency if you don't know how you're controlling expenses. Once you know where your costs are, you not only can control them better, but you can make better marketing decisions. The normal operating expense ratios range is typically between 60 to 80%, and the lower it is, the better. Below 70%, you're doing a really good job of controlling expenses, says Vice President AG Direct Credit Jerry Arl. If you're between 70 to 75%, you're probably doing okay. But if you start getting above that 75%, you're trending towards being a high-cost producer. And nobody wants to be a high-cost producer in the business world because that's taking money away from you. If you're part of the Patreon, I sent the link below that you can take a look at. So according to the formula, the OER, so that's going to be the total operating expense minus the depreciation over the gross revenue. So you're going to divide that gross revenue. In gematria, we have operating expense ratio, OER, an important indicator for fundamental stock analysis. That equals 333 in English reduction. So we already know the power behind this ratio, this metric for fundamental stock investing. Okay. And one thing you have to understand is there's 11 different stock market sectors currently in the stock market. So each sector is going to have a different OER depending on what their business operation is. Hey, what's up? League of Thieves NYC. I see you. Yeah. Hey, our charts are going up, baby. No, like seriously, our charts are actually going up. And if you have not been a part of the data production gang now, you're missing out because the money is starting to flow in now. Like it really is actually. So I'm excited. Back to operating expense ratio. So the technology sector, as we get into a little bit closer, we'll look. The technology sector has an average OER of 20 to 40%. This sector typically has high research and development costs in the software development expenses, but lower cost of goods sold, COGS, due to the intangible nature of many tech products. The healthcare sector, the average OER is 30 to 50%. Healthcare companies, especially pharmaceutical firms, spend a significant portion of their revenue on research and development, regulatory compliance, and operating costs. In the financial services sector, the average OER is 60% to 70%. Financial institutions, including banks and insurance companies, have high fixed costs and regulatory costs, contributing to higher OER. In the energy sector, the average OER is 20 to 40%. Energy companies, particularly oil and gas, have high capital expenditures, but relatively lower ongoing operating expenses. Consumer discretionary sector, average OER is 50 to 70%. This sector includes retail, automobiles, leisure industries, which have higher overhead costs and tend to fluctuate with consumer demand. Consumer staples sector has a OER of 40%, 40 to 60%. Consumer staples companies, which produce essential goods, have moderately high operating costs, but stable revenue streams. So those are the first six. Let me get this right so we go to the next. We have the industrial sector. which is 30% to 50%. Industrial companies typically have substantial manufacturing and labor costs, driving up operating expenses. Utility sector, OER 50% to 60%. Utilities have high infrastructure and maintenance costs, contributing to relatively high operating expense ratios. Real estate sector, average OER is 20% to 40%. Real estate companies often have lower operational costs relative to revenue, although property maintenance and taxes can be substantial. Media company, this is going back up. Let me see. So yes. So the 11th one is the media company. So 10, the material sector, average OER is 40% to 60%. The sector, which includes companies involved in mining, chemicals, and construction materials, tend to have high output and production costs. And the last one, the communication sector, which is kind of a broad sector. So I had to go to ChatGPT for this one. The average OER for this sector is 46%. You have, telecommunications companies. These companies often have significant capital expenditures, CapEx, due to network infrastructure development and maintenance, such as cell towers, fiber optic cables. But their operating expenses, which include labor, marketing, customer service, tend to be moderate. Factors influencing the OER is content production. Media companies producing original content, IG streaming services have higher operating expenses. Technology investments, continue investment in network infrastructure and bandwidth is required for telecom and internet companies. Marketing consumer acquisition, particularly high for companies trying to gain market share in competitive spaces like streaming and digital platform. While the range is 46%, it can be at the higher end for media and content heavy companies compared to infrastructure driven telecom companies. Media companies include traditional media like TV, radio, broadcasters, as well as digital media companies. These businesses can have relatively high operating expenses due to content production, distribution costs, and the need for continuous investment in technology and intellectual property. Internet service providers and digital platforms, these companies often have lower cost of goods sold, but may have considerable spending on technology, marketing, customer acquisition, and leading to a moderate OER. And so, with all this said, going back to the beginning, operating expense ratio is very important, and it tells a lot about the company. And you have to understand what sector your company is in depends on how they stack up to the comparable competition. Okay. And so literally you need to be looking at this at all your companies. Are they doing a good job controlling their expenses?